Today I'm going to be looking at the Nifty 50 index and also at the Indian macro situation. Before I start this video, please remember that I do them just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. So first of all, looking at the Nifty 50 on a quite a long time scale, it's obviously a very positive trend. And we see that since the central banks around the world embarked on further quantitative easing following the corona crash, just like with the S&P 500, with the Nifty 50, we also see this acceleration in the gradient at which the price is increasing. When I look at the Nifty 50, we see that over the last 5 years, its progress has been extremely impressive. And when I compare the Nifty 50 here with the FTSE 100 and the FTSE 250, you can see here why, as a UK-based investor, I'm very interested in the Nifty 50. It's far outperformed its UK equivalents. Now here we have IMF data on GDP, which for India, which is the red line, we see this lovely exponential trend, which the IMF is forecasting is going to increase substantially in the coming decades. And here we've got that data, but for China in green, against India in red and the UK in orange. First of all, you can see how the Indian economy has now eclipsed that of the UK. But also you've got the kind of ailing trend of the UK up against this nice exponential curve here for India. And a lot of people have obviously looked at the history of what happened with China, whereas China went through this amazing growth ever since the noughties. And the implication is that the same thing could happen for India. There's a great opportunity here to get in while we're still early in this curve. So to look at the macro data for India, and the black line here, these are interest rates, and the circles here are the latest monthly data I've got my hands on. The graph to the left here, these are yearly plots. You can see the interest rates in India, they obviously dropped down to 4% following the COVID crisis, but then in response, this is the same as everyone else is responding to inflation. The Indian government responded to inflation as well by increasing its interest rates, which are now at 6.5%. So obviously there isn't as much confidence in the Indian rupee as there are with, say, the US dollar or the pound sterling. So this forces the Indian government to have relatively higher interest rates, but they aren't actually that much high against, for example, the UK interest rates, which are at 5.25%. And then, of course, when compared with the amazing GDP growth that we're seeing. So I'd say that the interest rates are at quite a good number at the moment. There's scope for them to make cuts, but they're not too high like you would see with Egypt or somewhere, where it's going to really constrain the economy. So I do think that the interest rates are at quite a nice place. In green, we have GDP growth. And as you can see, that fell obviously due to COVID, but then it's rebounded back. And we currently have a number of, and the latest estimate is that we have about 8.4% year on year GDP growth, which is an extremely good number. And generally, actually, you can see we tended to have, even before Modi took office in 2014, we tended to have good, high, above 6% GDP numbers. And these consistently high GDP numbers, that's what you'd expect looking at these nominal GDP numbers provided by the IMF, and are supportive of this extremely strong GDP growth trend. And then inflation is the orange line, and you can see how since Modi came in, there was a severe drop in inflation. So obviously his government had some good policies there. See relatively low inflation, actually at about the 4%. Now 4% is actually the official government objective, and these are year-on-year inflation numbers. And obviously we had a spike in inflation, the same as everyone else, but the most recent number as of February worked out at 5.1%. So inflation's generally, which was in consideration of the high GDP growth, the inflation is actually looking in a very good place here. Now, for my dashboard here, the inflation there, that's the official number. The GDP growth and employment numbers, the targets are ones that I've put in according to the best of my judgment. And the GDP one, I've done not from year-on-year data, which I don't think is so good for a nowcast. For that, what I do is I take the monthly CPI increases, which I package into quarters, and then I'm using these quarterly CPI increases for my own best guess of what I think inflation is going to be. I 2x the most recent number, and then I take the two previous numbers to arrive at that estimate. So just here from the quarterly plots, you can really see a really good trend from 2022. The general trend, I mean, inflation does actually jump around a lot in India. It does have certain disadvantages, like, for example, it can be very sensitive to harvests, and whereas in the UK we have very predictable weather and really fertile soil, and pretty much what the harvest is going to be every year. That can be a lot more variable in India, so you get a lot more problems with food inflation and things. So it's a lot more, when I compare it to the UK plot that I've done in my earlier video, it does look a lot more jumping around, but you see the general trend in the recent years is looking a lot more bunched up and a lot more favourable and lower, particularly in light of the most recent prints. So I have the inflation at about 3% by my own guesstimate I've done for my purposes. So overall, we have a nice situation here of extremely high GDP growth and relatively low inflation. And then when I look at unemployment, the most recent number from February was 8%. And that's actually in line with the long-term trend. The general long-term trend has unemployment fixed at about 8%. Now, although 8% may look like a large number if you're more accustomed to looking at, say, UK unemployment figures, you've got to think of India as in the context of a country that's going to be growing its GDP a lot in the future, in which case this 8% number is quite useful, because it means that India will be able to continue creating jobs for a long period of time, and that can then soak up this unemployment without affecting the increased GDP growth. That's quite different to the UK, for example, where we have low unemployment, but the moment the economy starts to grow, because of the low unemployment, that drives up the cost of labour. Well, the current unemployment numbers for India here are very supportive, in contrast to the UK, are very supportive of future GDP growth. Now, according to this model I put together from my other videos I've done where I looked at the US and the UK economies, India, just the same as the US and the UK, are using a new Keynesian economics concept in how they use interest rates, and to a much smaller extent for India, quantitative easing, in order to meet the central bank objectives. But this is all enabled only by certain things, so they can only get away with these new Keynesian economics policies because the last few decades have had these deflationary forces at play, particularly technology, globalization, And so these deflationary forces then allow this behaviour to go ahead in a way that wouldn't have been possible in the last century. Also, you've then got to consider of inflationary causes that can come into play. And these are things for me to keep an eye on. For India, recently we've had obviously a bit of supply chain disruption because of the Red Sea crisis. And also, obviously, food inflation can be a problem. And actually, the Reserve Bank of India monthly bulletin that they come out with has whole sections on the predicted weather and the expected harvests, because the weather really can affect the Indian economy year to year in a way that we just take for total granted, not having to worry about in the UK, for example. So I've got these highlighted as things to look out for, but my general feel is that compared with the years 2000 to 2002, a lot of these short-term inflationary forces seem to have abated a bit, and it's a lot more in balance. There's other things to think about. One is how socialist is the government? So, and in terms of how much of GDP is actually just government spending. Now, the IMF have this wonderful data that they share, where you can go onto each country and look at what percentage of that country's GDP is government spending. And interestingly, what we see is, whereas the UK is at a very socialist 44%, India is actually only at 29%. So there's scope here for the Indian government to spend on public infrastructure projects, like motorways and things, which they are doing actually, by the way, without actually the total number being excessive, as is the case with the UK at the moment. Then you've also got to think about the Indian rupee, because again, the ability to do interest rate cuts is only enabled if your currency is robust enough. Now, in terms of government debt and fiscal deficit, following the COVID crisis, unfortunately, the Indian government made some decisions, the same as most governments in the world did, which increased the government debt substantially. However, like with a lot of the other governments, it's kind of stabilised at these higher levels of indebtedness. But it's certainly something to keep an eye on, because this higher government indebtedness, does create an opportunity for bond market vigilantes. So, of course, we like to look at the yield curves as well for an idea on, how robust the Indian rupee is. So here we have the Japanese yield curve, which is how a yield curve is supposed to look. Here's the UK yield curve, which is inverted, so that's a unhealthy yield curve. Well, the Indian yield curve is only minimally inverted. It's kind of generally actually a flat yield curve. So it's not a picture of health, but it's kind of not too bad either, particularly when we compare that to some other governments. And here I've got the Standard & Poor's ratings for different currencies. And you see India's here has a B rating. Although I think it's generally okay, the Indian government have to be careful. They are a little bit restricted compared with the USA, for example, in terms of how outrageous they can be with their monetary policy, without the bond markets then collapsing their currency. So it's all certainly a little bit embattled, and something that you've got to keep an eye on. Interestingly, though, when we look at the actual Indian rupee, it's actually been one of the most stable of all currencies. It's appreciated by a tiny amount against the US dollar, whereas, as you can see here, most of the other currencies in the world have depreciated against the US dollar. And as you can see from these green plots here, the volatility of the rupee is extremely small. It's one of the least volatile currencies in the world. And another thing to think about is quantitative easing, because obviously the more money printing that your central bank does, that will start to put question marks over the resilience of your currency. Now, actually, it's been hard for me to get data for that for India, but they do some. And I've got here this graph here where, I mean, what I've been doing is I've been looking at what is the total balance sheet of the Reserve Bank of India. And we can see that from the noughties, it went up quite a lot. So, you know, this actually looks quite similar to what you see in the US or the UK. So, yeah, you know, the Indian government is following the same kind of New Keynesian economics pattern as if it was a America or a UK or an EU. But when we look at this graph, we see that actually they've been clawing that back. And when you compare, and in terms of as a percentage of GDP, the amount of quantitative easing, or at least the size of the central bank balance sheet, is much lower for India than it is for the Euro area, for the UK or the US. So I have started looking at how much is on the Reserve Bank of India balance sheet to monitor it, but generally it's kind of minimal. So to summarize, we need to keep an eye on the fiscal situation for India moving forward, but they currently have, but the macro of India doesn't look very positive at the moment to me. When you look at the progress of the Nifty 50 and see how that aligns with the increase in GDP of India as measured by the IMF, these numbers really do trace over that almost perfectly. We have very high GDP growth and inflation is relatively low. So we don't really see anything to stop that growth continuing. And then the cherry on the cake is how, unlike in the UK, where not enough people are having babies, in India, there's plenty of people having babies, and there's an unemployment number of 8%. So there's plenty of people for the jobs. So you can see this high GDP growth continuing without the cost of labour going up, thus affecting the growth in the economy. So to me, this macro data looks very positive. So I'm using this as my, my main eyeball of the situation. But I also have my dashboard here where I can start populating data on a month-by-month basis as it comes in. And to do that, I'm using mostly the Reserve Bank of India monthly bulletins. And these really are beautiful documents. I think they put the Bank of England to shame. You have extremely well-written accounts of every aspect of the Indian economy. And it's all beautifully referenced. So every assertion made, you can go and see the reference and the data where that's come from. And then it's garnished with these beautiful data tables where on every aspect of the Indian economy, you get some really useful data here. And then at the back, they have these appendices where all that raw data consolidated, and then all that data then cross-references back to the assertions being made in the commentary by the Reserve Bank of India. So this is only my first attempt of looking at the Indian macro situation. But as time goes on, I think I'll get more confident in a better picture of the economy as I get more used to looking at the data. As we jump from the yearly data plots here through to these monthly updates, we can see how the interest rates have been kept stable at 6.5% for over a year now. And with an election coming up, my guess is that it will actually be kept the same ahead of this election. But I think there's lots of scope for looking at the other data. I think there's lots of scope for the Reserve Bank of India to start cutting interest rates a bit if they need to. Here I've got, I couldn't find raw QE data, but I have got the assets of the bank in Indian rupees, and actually the Indian version of QE in 2021 they called GSAP 1.0 and GSAP 2.0. And we see that increased the central bank's balance sheet from 29 trillion rupees to 33 trillion. But then that was then reduced. They did tightening, and the current number, about 35 trillion, is, I think, fairly minimal, really, when we compare to what the other central banks have been getting up to. So the year-on-year inflation is gradually reducing, but like I said, I don't really find the year-on-year numbers that useful. I prefer the monthly CPI plots. And it actually did get a bit ahead of itself, the inflation did last year, but it's now currently looking fairly on the low side. I looked at the latest March report for the Reserve Bank of India, and they actually said in there that they're updating their estimates with year-on-year inflation expected to be dropping to 4% by the end of this year, and real GDP growth expected to be 7% at the end of this year. And both of those numbers are improvements on the previous estimates. I've got here house prices, and it took a bit of a wobble, particularly in 2021, but house prices are steadily improving at the moment. And then here we have this amazing quarterly year-on-year, reported quarterly year-on-year GDP growth numbers that are fully in line with this amazing GDP growth trajectory that we see for India. The unemployment actually jumped up to 8% in February after a really low number in January. But like I said before, unemployment just tends to jump around a lot in India. Case I actually think the longer term trend is more useful than monthly data plots. I've got here the GDP growth in long term. It's quite interesting. You see before the noughties, a change in profile for India. This is more resembling a country which is really struggling to transform itself, kind of thing, into a more modern economy. But then from the noughties, it's a lot less volatile on a year-to-year basis. And apart from this blip caused by the COVID decision making by the governments, this is generally very high, sustained GDP growth over a long period of time. Here's M2 money supply, and I do see a nice, I'll definitely be keeping track of this because I like looking at the parallel between increased money supply and increased GDP growth, which also has a exponential appearance. And I like it how that lines up with the progress of the Nifty 50. And here we see the long-term trend in house prices. The index is called the Residex, and that looks very impressive. And in the latest Reserve Bank of India bulletin, they actually had these projections for GDP growth and inflation. And so I'm going to be having great fun plotting the actual results we get against what their predictions were. And finally, there's a table here from the World Bank, which for me really does kind of summarize the investment case for India, because we see how in 2024 we have 3% GDP growth predicted worldwide, and whereas the US is at 1.6% and the euro area 0.7%. India is best of all the BRICS countries with a predicted GDP growth, according to the World Bank, of 6.4%. So as you can see, India is completely wiping the floor with most of the world when it comes to GDP growth at the moment. So to summarise, we need to always be mindful of the fiscal situation, because the Indian government has relied on a bit of fiscal indiscipline in order to get the economy where it is. But generally, the Indian rupee is a stable currency at the moment, and this all looks fairly settled. And on those foundations, the current basic macro data for India looks excellent. We have stable unemployment, extremely high GDP growth, and relatively small inflation. So there's no reason not to believe the IMF estimates for this exponential future growth in Indian GDP. And so that looks very positive for the Nifty 50 index. So that completes this video. My next video, I'm going to be taking a look at more qualitative aspects of the Indian economy, things like demographics, and taking a look at the actual stock market composition as well, and things like that. And also asking the question, how can a UK investor invest in the Nifty 50 in a tax efficient way? But that's it for now. I hope you found this video useful, and good luck with your own investment journey.
I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.